Let's get your trading week started. Live from New York City this morning. Good morning, good morning. This equity market still rallying. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, equity markets delivering 7 weeks of gains as Fed officials attempt to push back against pivot talk, and Goldman already lifting its outlook for next year. We begin with the big issue, the bears getting absolutely steamrolled.
Doves fly and bulls run.
We've had a massive rally in equities.
Rally across risk assets.
Santa Claus rally.
Quite a rally.
Right now we're kind of in this Goldilocks phase.
The trade for today is the Fed's going to ease.
What we learned from the Fed is that we have to start entertaining our bull case a little bit more.
That was a green light.
The bears have pivoted.
We have a relatively bullish view on the S&P 500 for the year ahead.
2024, we're going to play from the bullish side.
I think equities have a ways to go.
We have some room for risk to continue to rally.
You could see them test and challenge and surpass the old highs.
You can't really fight this until there's some kind of fundamental data from the economy side that pushes back.
Until we see data that it's not working, it's risk on.
It's risk on right now. Joining us to discuss BlackRock's Kate Moore, Bank of America's Jared Woodard. Kate, are there any bears left?
There are still a few holdouts, I think, John. I think there are a number of people who looked at the phenomenal move in the equity markets last week and risk assets kind of broadly and said, this is not sustainable. But no one wants to stand in front of this train going into year end. I think we'll see a lot of adjustment of positioning in January, however, and some of those bears will be a little bit bolder, especially if we rally over the next 2 weeks.
The bears are sounding bullish this morning. Mike Wilson and Morgan Stanley, a bullish outcome for stocks off the back of what we heard from Chairman Powell. Jared Woodard, are we setting ourselves up for disappointment? How high is the bar now going into 2024?
Yeah, I think it's fair to say, John, that the gains from this pivot by the Fed are fully reflected in the market. I mean, never mind the Santa Claus rally, this market, bonds and stocks alike, have trimmed the tree. They popped the champagne cork for New Year's. They booked a ticket for summer vacation. They're so far ahead of what the economic fundamentals would suggest. If anything, this is a great point to start taking profits and look for alternative positioning for next year.
Jared, you'd pull back. Where would you pull back?
Well, I'd take gains in unprofitable tech. That's been one of the things that's rallied the most in this short covering rally. And the most shorted stocks have been huge beneficiaries, as Kate mentioned, as bears pull back. But when you have low quality rallying and when you have fundamentals that haven't really improved sharply in the last several weeks, if anything, we think the risk of inflation in the second half of next year is still a big concern. So investing in things that are going to be robust to inflation and to things that are higher up in quality seems like a great way to position for next year at a time when everyone else is just scrambling for any kind of junk they can find.
It truly has been an everything rally. Breadth has improved. Kate, I just wonder from your perspective, if that's the real deal or whether that's a head fake.
Yeah, look, I think there's a little bit of real deal and a little bit of head fake actually mixed in here, John. And on the one hand, you have seen a lot of people reposition, kind of invest in the laggards, rotate, try and neutralize some of their underweights. And on the other hand, there's this acknowledgement that, let's say, particularly in the small cap space, that had been under tremendous amount of pressure as rates continue to rise, that if the worst is behind us in terms of policy tightening, there is potential for some of these companies to perform okay. I'm not going to say phenomenal, but okay in 2024. So the earnings story has a little bit less downward pressure, I would say, in the small cap space. So there's both the repositioning, I think, and an acknowledgement the fundamentals could improve.
Okay, talk to me about the sectors you do like, tech and discretionary. Are the winners of this year the winners of next year?
Yeah, we like tech, discretionary, but we're looking for opportunities, John, across all sectors at this point. I might take a little bit more of a bullish look and a little bit more constructive than Jared right now and say, yes, it's true that we've started to price in a lot of the best news from the monetary policy front, but there's a lot of good fundamental stories across all of the sectors at this point. Companies have done the work in terms of reducing their expenses. They continue to manage to the bottom line, and I think they're going to deliver actually solid earnings across consumer, across technology enablers, and even some cyclical parts in 2024.
Jared, would you agree with that?
Yeah, look, when I mentioned going into higher quality, I'm thinking of companies and sectors where, You have strong free cash flow with solid balance sheets that have already endured a lot of pain over the past decade. To me, that's financials, that's energy. We think about Asian equities in particular, Korea, Japan, India even, where you've got decent or even compelling valuation, lots of corporate reform, a positive macro environment, and if the consensus view is right, that you have a weaker dollar next year, a friendly Fed, those Asian stocks are really poised to benefit from a weaker dollar as well.
Jared, you mentioned the banks. Let's talk about them. On the S&P 500, they are higher by 26%. Not year to date, but since the end of October. Is that just off the back of the bond market move, or is there something sustainable in your mind that we're all missing?
Well, I think it's a few things. There's a taking out of some of the risk around real estate and some of those tail risk scenarios that have dogged the market this year. There's the understanding that a friendlier Fed, friendlier cost of capital is going to boost multiple lines of businesses across banks. And positioning here matters too. When people have been so bearish on especially larger cap banks all year, when you have a rally of this type, you would expect that some of those most shorted names to get an uplift.
Okay, what is there to like about the financials from your perspective?
I got to be honest, John, I'm not overly excited about the financials at this point. I'd be putting my incremental risk in maybe some different places. I mentioned discretionary before. We've had, a constructive view on the sector, but I could see a broadening out in terms of retail in particular. If we continue to have what we've seen, which is like strong wage growth, but not so strong, inflation continuing to cool, but I'm not talking about outright aggressive deflation, stable monetary policy, and sentiment settling, you can see a broadening out in the discretionary space and across retail. And so that's a place I'm doing a little bit of work and getting more excited about. The banks, I just don't see a huge outperformance catalyst in 2024.
Jared, what are we missing? I'll ask that twice. What are we missing?
Well, I think the most important thing for investors to think about right now is what's priced in, what's reflected in the market today. And the consensus view on a perfect landing, slower growth, friendly and disinflation, and a Fed that's very happy to cut is, I think, fully reflected in the market. So my point earlier about being tactically a bit cautious reflects the fact that the market's already well ahead of the Fed. That's why you have folks coming out in the days after saying maybe people need to reconsider. That's why my colleagues at Bank of America just have the rate forecast for cuts next year, but which is still much less dovish than the market as a whole. If you're an investor approaching the market, from a neutral standing point today, I think you have to have a barbell of things that are tactically a little bit more cautious, but with looking for cyclical value opportunities for the second half of this year. Structural inflation, we think, is a really big theme. That means you need to be in equities, you need to be in commodities and assets that can benefit from a structurally higher stagflationary or inflationary environment. That doesn't mean you need to load up the boat at this moment, but it does mean that the asset mix that most investors have in benchmarks and model portfolios is ill-suited to the world as we see it today.
We'll come back to that. This market's still rallying about 23 minutes out from the opening bell. Equity futures positive here by 0.3% on the S&P. Let's get to Bloomberg's Katie Greifeld for more. Morning, Katie.
Morning, John. Well, we are officially on record watch. Futures show that the S&P 500 set to open just around 4782. That's a breath away from the index's record close just below 4,800 in January 2022. And it's been a really interesting road to get back here. The S&P 500 has surged almost 15% from late October alone. That's as traders priced in increasingly dramatic rate cuts. And it was looking like we were gearing up for another epic fight against the Fed. But after Jerome Powell's surprisingly dovish performance last week, maybe fighting the Fed worked out this time. And big tech bulls, they're certainly declaring victory. Even though we've really seen this rally broaden out over the last 2 months, that hasn't come at the expense of tech. The NASDAQ 100, as you can see right there, it's rocketed almost 18% higher since late October, outpacing the S&P 500. It closed at a record high on Friday and overall up about 50% in 2023, on track for the best year since 2009. Now, a lot of this equity rally, as you've pointed out, it's being fueled by the bond market. 10-year yields currently trading near 3.9%. For context, as you know, we were above 5% not too long ago. And while rising yields, maybe they weren't the stumbling block that bears expected, it certainly appears that investors think lower yields will help this rally. A note of caution would be the parade of Fed speakers that we've heard from in the last few days, including John Williams kicking us off on Friday, but so far not really making a dent.
Not a dent. in any way, shape or form. Katie, thank you for the update. On the bond market today, yields higher by 4 basis points or so on a 10-year maturity. Let's call it 3.95 on that yield. Though, as Katie suggested, just a massive move in the last couple of months, both in equities and in bonds as well. Jared, you can't say stagflation then walk away. We've got to come back to it. Stagflation. Can you build on that a little bit more? Is that the kind of environment you're looking for next year?
I think in the second half of next year, there's a very meaningful risk that you see a rebound in inflation. And my colleagues in economics and across the firm, I think, have written about this as well as one of the risk scenarios. Because when you look at all the whole economy, it doesn't matter households, corporates, or government, all the major sectors are in an environment in which their sensitivity to rate hikes is extremely low. There's still, lots of risk of higher inflation, and many of the metrics that we watch are still 1 or 2 standard deviations above the long-term norm. I'll give you a couple quick examples. The U.S. federal budget deficit, 5% of GDP, unprecedented to be spending this much money with unemployment near record lows. And that's completely impervious for the Fed. People will tell you, John, oh, don't worry, Congress is going to pull back on spending next year. We think that's irrelevant. Our analysts have told me that something like 77% of the fiscal stimulus that's already been authorized by Congress in the last several years hasn't even been spent yet. That's going to still come through. Households and corporates, it's the same story. Households are sitting on excess savings, still around $950 billion. People very happy to buy houses at any price. Corporates are facing private credit dry powder to the tune of $500 billion. Very happy to step in and plug any gaps in lending that might come about. And it's worth noting, too, that high-yield issuers still sitting on big cash piles. The interest coverage ratio for high-yield bond issuers is still 1 standard deviation above the long-term average. This is something you see very early cycle, not end of cycle, and it's the kind of thing that if the Fed does cut aggressively, you could see a rebound in inflation. Given wage growth and all the other parts of the economy, they're still looking pretty hot.
Okay, what happens if Jared's right?
I mean, if inflation were to rebound, which I would say we put as a pretty low probability event in the second half of next year, because we do think we're going to see a steady deceleration in overall economic activity, perhaps not a big recession. I think we're kind of in a glide path here. But if we were to see a rebound in inflation, that certainly would be a big hit for risk appetite. If the Fed had to talk about normalizing policy further, that would be a big risk for the equity market. But I do want to make a point here about one of the risks for the second half of 2024 that we need to talk about, which is 2024 is an election year. And during election years, especially if there's a chance of a significant change in administration and policy, sometimes companies sit back a little bit and don't engage in capital expenditure outside of necessary and maintenance CapEx, right? They just sort of say, we'll do what's necessary, but let's see if there's a change in the tax regime or a change in regulation that's going to impact my ability to do business. So sometimes in the kind of the fourth year of a presidential cycle, during a big contested election, you will see a change in spending. So that I'm watching, which may lead to some dampness in the economy. It's not keeping me up at night, but it's something that's definitely a risk.
Kate, sit tight. She's going to stick with us. Kate Moore there alongside Jared Woodard. Right now in equity markets, about 17 minutes away from the opening bell. Futures still positive by 0.25%. With some movers this morning going into the opening bell, let's say good morning to Simone Foxman.
Yeah, good morning, John. M&A driving a lot of our biggest movers this morning. The big one, a $14.1 billion deal for U.S. steel. This coming from Nippon Steel in Japan. This would equate to about $55 a share in cash. You can see right now U.S. Steel in the pre-market trading relatively close to that. That's about 142% premium to Friday. You may remember this name had been the subject of a bidding war, but those offers were like $32, $35 a share. So much higher. Also an M&A, Adobe and Figma scrapping their $20 billion merger pact after Adobe saying it wouldn't make some changes to win approval from the UK's Competition and Markets Authority. Shares there higher in the pre-market. Also watching Coinbase. The SEC rejected its proposal for new regulations for the digital asset sector. Now the company is going back to the appeals court, asking the SEC to be forced to move forward with new rules. We saw Bitcoin briefly drop below $41,000. It is among, Coinbase is among other crypto-tied names that are falling this morning, John.
Simone, thank you. More from Simone around the opening bell. Coming up on this program, pushing back against pivot talk.
We've made a lot of progress in 2023, but I still caution everybody, it's not done. And so the data is going to drive what's going to happen to rates. For sure, it's too early to declare victory.
Conversation up next.
And a question of when will it become appropriate to begin dialing back the amount of policy restraint in place. That begins to come into view and is clearly a topic of discussion out in the world and also a discussion for us at our meeting today.
That was Wednesday. Chairman Powell adding fuel to the pivot party, prompting pushback from a growing number of Fed officials looking to temper rate cut expectations. New York Fed President John Williams leading the charge on Friday, saying bets on a March reduction are premature, emphasizing, quote, we aren't really talking about rate cuts. Austin Goolsbee of Chicago also weighing in.
2023 looks like it's going to end up being a very substantial reduction in inflation without a big increase in the unemployment rate. That's the golden path that I talked about. But we're still above the target. I still caution everybody, it's not done. And so the data is going to drive what's going to happen to rates. For sure, it's too early to declare victory.
Bloomberg's Ira Jersey joining us now for more. Ira, did you get all of that? Have we got a clear picture now?
Yeah, no, it's a more muddled picture, I think, John. I think that's pretty clear. You know, I agree with the speakers actually since Jay Powell, right? The Federal Reserve, I think in general, wants to be on hold and wants to be data dependent. The problem is that the market seems to think that either the Fed's hiking or it's easing. It can't just stay on hold for a long period of time. And I think the challenge that the Fed's having is communication. It's saying, look, we're going to be on hold until one of these two things breaks. Either unemployment goes way higher or inflation is at or near our target. And I think Jay Powell didn't do a great job communicating that last week. So that's one reason why you had the very substantial rally in a relatively illiquid December market.
Ira, why do you think we're holding on to encouragement and ignoring the pushback that we've had from Fed officials?
Yeah, I think the market, you know, people, well, for one thing, in the rate market in particular, we were having such a bad year just 2 months ago. And now that we've had this massive rally, I think people just want to square up positions, go home, you know, have a nice holiday, just be flat the market, and then come in next year and try to figure out how to position based on maybe the next payrolls report and CPI, which we still get relatively early in January. You will probably see a little bit of profit taking, I would imagine. You look at some of the survey data on Treasury sentiment, for example, the JP Morgan data came out over the weekend, and you know, that showed that a lot of longs are now more flat in terms of Treasury positioning. So, and I think we'll see a little bit more of that. So, but you know, that being said, I think 4% plus or minus 10 basis points is probably where we'll end the year on 10-year yields.
All right, we've had a big conversation throughout this morning about the difference between cutting interest rates and easing with a focus on the real rate. From the market's perspective, Ira, a question that I've lent on this morning, do you think that's a distinction without a difference for financial markets?
Well, I think there is a little bit of question in that, because when you listen to Chris Waller, and what he mentioned was, well, look, if inflation's coming down, we're getting more restrictive, right? So that idea that the real Fed funds rate is actually going up as inflation comes down, and the market, I think, has kind of leaned into that a little bit, and certainly what Jay Powell said kind of had some confirmation bias to that. But that being said, you look at what real rates have done in the market, and TIPS real yields now at 1.75% on 10-year TIPS. That means that the market at least thinks that there's going to be much easier monetary policy going forward, as opposed to when we were 75 basis points higher in terms of real yields. So yeah, I do think that the market is, you know, leading into these individual statements that are being made instead of looking at the totality of what everyone's saying at the Fed right now.
Ira Jersey, thank you, sir, of Bloomberg Intelligence on the latest. A final word with Kate Moore, please. Kate, let's go there. The Federal Reserve. Who do I listen to? The Chairman Powell that I heard from at the start of December, the one I heard from on Wednesday, the people I've heard from subsequently. Who do I listen to?
I think we listen to them all, John. That's not a cop-out answer. I mean, I think Powell was right in indicating that we can start discussing the possibility of rate cuts if the growth, inflation, and employment data suggest that's the right and appropriate move. But I think, the other Fed speakers who've come out and basically said, hey, we're not promising rate cuts in the near term, that there's a lot of uncertainty in the macro data, that we're still coming out of a very unusual cycle from the pandemic, and we have to wait and see, is also worth paying attention to. I think the message for markets is, don't get ahead of yourself in expecting a huge number of rate cuts in the first half of 2024. We still think growth is going to look quite good. Some of the disinflationary pressures or the speed of disinflation may ease a little bit in the first part of 2024. But that doesn't mean, and I'm going to make another pitch for this, that it's game over for equities. I still think there's a risk-on move to be had, John, going into 2024.
Are there some basic underlying assumptions you're making on the bond market, though, Kate, to make that call?
Yeah, that's right. To Ira's point, I would expect stability in yields. If we had a huge amount of bond volatility, if we ended up seeing, let's say, a sustainable rise above 410, and there was upward pressure, I think that would be a little bit tougher case for equities. But I do think we're going to be able to move past the obsession with monetary policy, the obsession with Fed speak, and focus a little bit more on fundamentals, which I think are going to improve. And by fundamentals, I mean specifically earnings next year.
Okay, I hope that is not just a dream. That is actually a call. It might
too,
actually
John.
materialise. I think we're all on the same page. We all want to stop talking about this. Kate, thank you. Always fantastic to catch up with the brilliant Kate Moore of BlackRock, alongside Jared Woodard of Bank of America. Going into the opening bell, about 7 minutes away. Equity futures still positive here by 0.2%, despite all of that pushback from Fed officials. Coming up next, the morning calls, and later, State Street's Laurie Heinel on why uncertainty is bound to persist in 2024. More still ahead from New York City. Good morning. Same story, 5 minutes out from the opening bout. The rally continues on the S&P 500, up by around about 1/3%. That's the price action. Let's get you some morning calls. Your first one from Guggenheim, upgrading Snap to buy. Analysts saying the demand for digital advertising is poised to increase and holds untapped potential. Your second call from JMP Securities, downgrading Shopify to market perform, citing profit margin headwinds and the stock's elevated valuation. That stock is negative by around about 1.6% in the pre-market. And your third and final call from the team at Truist, raising its price target on Dollar General to $125, saying the retailer is moving with urgency to improve in-store operations. That stock is positive by, let's say, 0.75% in early trading. About 4 minutes away from the opening bell. Coming up next on this program, State Street's Laurie Heinel on her 2024 outlook following 7 weeks of gains on the S&P 500. Are we set to make it week 8? Your equity market positive, your opening bell is just around the corner. Five seconds away from the opening bow this morning. Good morning. Your equity market positive by 1/3% on the S&P 500 following 7 weeks of gains on the S&P 500, the longest weekly winning streak going back to November 2017. Can we make it week 8? The Nasdaq and the S&P slightly elevated going into the opening bow. There is your opening bow. Switch up the board and get to the bond market. Yields look like this on a 10-year, higher by 3 basis points. Your yield this morning, 3.9445. Getting tons of pushback from Fed officials. The ECB trying to sound hawkish. Let me tell you this. The pushback is only as credible as the data behind it, and the data in Europe is absolutely terrible. German business confidence, soft, weak. The PMIs out on Friday, not pretty at all. The euro holding on to 109, 109.30 and positive by 0.3%. Crude rallying by 3 percentage points, 73.60 on WTI this morning. About 30 seconds into the session, here's the state of play for you. On the S&P 500, we are just about positive by 0.2%. The Nasdaq Composite is totally unchanged. One stock to watch at the open, U.S. Steel. Japanese steel maker Nippon agreeing to buy the company for $14.1 billion. Simone Foxman has this one. Hey, Simone.
Hey, John. Yeah, what would happen to U.S. Steel had been the talk of the metals market ever since August. You may remember then it received some bids from the likes of Cleveland-Cliffs, from S-Mark. Those bids were around $7.25 to $7.8 billion. None of them panned out, but the company did go forward with a strategic review. And apparently that was a smart move because Nippon agreeing to pay $14.1 billion in cash. That equates to about $55 a share, and that explains some of this dramatic pop that we were seeing, over 26% in the shares this morning. Now, the quick react from BMO here, surprisingly high price for U.S. Steel, and the union's strong support for the Cleveland-Cliffs bid that had happened back in August, and that company's ability to maybe bid again could still complicate this transaction. But overall, U.S. Steel has been trying to transform itself, focus more on remelting scrap into steel rather than turning iron ore into steel. And overall, steel producers may really benefit from some of the Inflation Reduction Act programs, broader investment in green infrastructure, especially in the United States. Nippon also citing growing U.S. population. Either way, we can see a clear share reaction for U.S. Steel this morning. We're also seeing both Cleveland-Cliffs and Nucor rising in early trading, John.
Up almost 27%. Simone, thanks for that. Let's stick with deals and check out the latest move from Warren Buffett, purchasing nearly $590 million of Oxy stock. Emily Grafea has the story. Morning, Emily.
Good morning, John. That's right. This latest purchase just adds to Warren Buffett's stake in Occidental. Berkshire Hathaway has been steadily increasing their shares of the energy company for the last 3 years. This latest $590 million stock purchase coming after Occidental announced that $10.8 billion deal with Crown Rock. Now, while Occidental likely didn't need Berkshire's support to fund this acquisition, it nonetheless shows a nod of approval from Warren Buffett that this deal is something that he approves of. Now, the shares up of Occidental right now, about 2% in the pre-market, down for the year, but I don't think Warren Buffett minds that stock was up 100% or over 100% in 2022, John.
Emily, thank you. Just short of 60 there. Energy stocks really underperforming, have not participated in the rally that we've seen more broadly on the S&P 500 and elsewhere. Stocks this morning just about positive. 3 minutes into the session, up by a third of 1%. The Nasdaq with a little lift, a small one, up by 0.2%. Let's turn to tech. Apple in the spotlight as additional Chinese government agencies order staff not to bring iPhones to work, according to our reporting. Alex Webb has the latest on this. Alex, how much worse is this getting for Apple over in China?
It's getting certainly quite a bit worse, but it's nowhere near catastrophic just yet. What we heard a few months ago is that, particularly in Beijing and Tianjin, that there was a pushback from some government agencies and state-owned companies, not least PetroChina, huge employer in that part of the world, forbidding them essentially from using Apple devices in the workplace. What we've now seen, according to Bloomberg reporting, is this is extended to 8 further regions. Now, Chinese government has said that this is not a top-down edict. The real question here is about the mood music, because these sales in and of themselves are unlikely to take a significant dent out of the $70 billion in revenue that Apple does in China. But China is, of course, one of the few bright spots in growth that Apple has right now. And if there is a push to support more Chinese manufacturers, a sort of nationalist push that we saw 6 or 7 years ago, well, 6 or 7 years ago, that created a $20 billion decline in revenue over a number of years. So if that is going to be the case this time around, that is something that Apple shareholders need to worry about. We don't yet fully know that that's the case, but it does seem to be possibly heading in that direction.
Alex, if you knew everything that had gone on with the fundamentals for Apple this year, the tension in China, would you have guessed that the stock was up by more than 50%?
I mean, look, Apple somehow, it manages to keep charging on. It has, huge free cash flow every year. Sometimes it seems they don't even know how to spend it. They can't return it to shareholders fast enough. They can't invest it in new products fast enough. So never bet against, well, I don't want to say it's foolish. It can be seen as foolish to bet against Apple because somehow they seem to manage to pull it out the hat. But this is possibly a major headwind.
It would have hurt this year, that's for sure. Alex, appreciate the update. Alex Webb there on Apple. The stock is down by about 1% this morning, still higher year to date by something like 50%. Let's turn to retail. VF Corp working to bring parts of its IT system back online after it detected a cyber disruption. Katie Greifeld on top of this story. Hey, Katie.
Hey, John. Yeah, VF Corp disclosing in a filing today that a cyber attack is disrupting its ability to fulfill its orders. Specifically, quote, unauthorized actors were detected on a portion of the company's information technology system on last Wednesday, December 13th, and that this, quote, threat actor also stole personal and other data. Now, this is an ongoing matter. VF Corp has yet to determine the full scope of the incident and is working with external cybersecurity experts and has shut down some of its systems. Now, while its retail stores are still open, customers can still place online orders. Fulfillment has been affected, and as a result, the disruption has caused and is, quote, reasonably likely to continue to have a material impact on VF Corp's operations. That, again, according to today's filing, shares off about 7.5% as a result, adding to an already difficult 2023 for this company. All told, VF Corp down by more than 30% in 2023.
Katie, thank you. Down hard in the early part of trading, 6 or 7 minutes into the session. Katie Greifeld there on the latest for VF Corp. Here's the latest in this market right now. So we're about 6 or 7 minutes into the session, on record high watch on the S&P 500. Katie went through the numbers a little bit earlier, positive by 0.3%. I started the program by asking, are there any bears left, particularly after what we heard from Mike Wilson and Morgan Stanley, calling it a bullish outcome for stocks, what we've seen in the last week. Think about being bullish a month ago, the middle of November, what being bullish looked like, something like 4,700 on the S&P 500, just a bit of upside. We've left all of that behind now, added more weight to this rally, and the likes of Goldman Sachs and David Kostin have had to hike the price target for next year, a price target that was only about a month old. Middle of November, 4,700. Going into the back end of December, the new price target is 5,100 for year-end next year. Right now on the S&P, 47.33. State Street's Laurie Heinel looking ahead to next year, writing this. As we head into 2024, we anticipate uncertainty to persist. It will likely be a year in flux, with many factors pressuring the path to global recovery. Laurie, I'm pleased to say, joins us right now. Laurie, refreshing just to really lean into uncertainty and not just say 5,100, 5,200 on the S&P. Why aren't you joining in with that crowd, Laurie? What's holding you back?
Well, there are a couple of things that we're concerned about for 2024. First and foremost, valuations have really gotten stretched here. So to envisage equities continue to go higher and higher from here seems a little bit naive from our vantage point. The second thing is that we do see the economy slowing. Here in the U.S., for example, we think growth is going to be somewhere closer to 2%, which hardly justifies the kind of levels that we see right now in stocks. And then lastly, we actually see better opportunities in fixed income. Obviously, we've had a massive rally from the 5% handle on the 10-year, but we think even near 4% yields, 10-year treasuries look pretty attractive.
Laurie, just going through your fixed income calls of the last month or so, I had written down that you're looking for lower rates, steeper curves and wider credit spreads. Is that still correct? And is that the recession trade you're looking for next year?
Well, it certainly is still correct, and it doesn't have to be a recession that drives that. We think there's still a pretty good chance that we achieve a soft landing. Certainly, we haven't seen all of the effects of the interest rate hikes here in the U.S. filter through the economy, but there has been an incredible amount of resiliency. So our core view is that against a backdrop where we think growth is about 2%, inflation comes down below 3% by end of year-end, you actually do see a pretty meaningful movement in rates. And against that backdrop, we still think that credit is a little bit dicey because, of course, anything that slows the economy potentially jeopardizes those credit returns.
Credit spreads are 336 basis points, high yield spreads. I think we're literally at the tights of the year, maybe just off them by a whisker, by a hair. Laurie, what's driving credit spreads this much tighter going into an economy that a lot of people acknowledge, even if they are bullish on equities, it's an economy that's going to slow?
Well, there are a couple of things. Certainly, there still is a yield pickup. So to the degree that you're looking for something more than 3 or 4%, you can get that in high yield bonds. And as you note, equities doing better in here actually helps provide a little bit of cushion, if you will, against those companies. But we're not a buyer here. We actually think that there is vulnerability, and particularly, as you say, being at the tights on spreads at a time when we've also seen rally in rates, that to us is a very toxic cocktail.
One thing that has developed in the equity market is improving breadth. It's been a big topic of conversation on Wall Street on this programme as well. The banks have started to perform, the small caps have started to do well, the laggards have started to pick up. We're starting to see increased participation. Laurie, do you see reason to believe that can continue, given your broader macro call into next year?
Well, we certainly do, but here again, part of the question is how big of an impact does that actually make? So we do expect broader broadening out of the markets as you start to see other parts participate in here, and you start to see money sort of flow into more quality trades, into places where there's been a little bit more valuation sensitivity. But again, that really doesn't destabilize our overarching view that equities could be a very dicey place to navigate in 2024.
Is it bonds over stocks for you then?
It still is, and again, I would have had higher conviction, 45 or 60 days ago. But we still do think that there's plenty of good room for bonds to run, and 4% coupon, risk-adjusted return looks pretty good in bonds.
What's the data point you're focused on right now, Laurie? Because a lot of things on the surface look pretty decent. Unemployment close to 4, GDP still holding in there. What are you focused on?
Well, the biggest thing we're going to be focused on in the aggregate is going to be earnings in 2024, because there are going to be a lot of pressures on equities, including refinancing risk as we head into the back end of 2024. Certainly inflation, while we think it's more or less run its course, there's going to be still pockets of inflationary pressures, and you're going to still see some of the wage increases that accumulated over the course of 24 sort of feed into that. So earnings is going to be one of the big things that we'll have our eye on in 2024.
Laurie, thank you for the input this morning and through the whole of 2023. Appreciate it. Looking forward to covering 2024 with you in just a month or so's time. Laurie Heinel there of State Street on the latest. We're about 11 or 12 minutes into the session. Equities holding up by, let's call it 0.25% on the S&P, up by 0.2% on the Nasdaq this morning. Coming up on this programme, BP pausing Red Sea shipments after an escalation in attacks by Houthi militants.
8% of global LNG, about 9% of global oil and petroleum products. So an enormous amount of energy that goes into the world goes through the Red Sea.
Some big moves in the commodity market off the back of these moves. That conversation up next.
%8 of global LNG, about 9% of global oil and petroleum products. So an enormous amount of energy that goes into the world goes through the Red Sea. The Houthis seem to be doing something that's fundamentally and conceptually similar to U.S. secondary sanctions. Initially, they started targeting anything with nexus to Israel, Israeli ownership or management of the shipping company or the tanker, or for that matter, just cargoes going into or out of Israel. They've cast the net even more broadly now.
That was Kevin Burke of Clearview Energy weighing in on a developing story. BP announcing a halt on all shipments through the Red Sea following a series of escalating attacks by Houthi militants. The oil giant saying this: "We will keep this precautionary pause under ongoing review, subject to circumstances as they evolve in the region." Rerouting means bypassing the Suez Canal, adding thousands of miles to scheduled cargo deliveries. Let's get to the team coverage. Kelly Lyons in D.C., Simon Casey here in New York. Simon, let's start with you. Developing story. What are you learning so far?
Well, as you said, John, I mean, we've had BP come out this morning. This situation is escalating very quickly. At the end of last week, we had some tanker operators saying they were really concerned about events. Now it seems like we're on the way to maybe perhaps all tanker traffic beginning to be paused from shipping through what is arguably one of the world's most important routes for energy.
Simon, have they been attacked, or are they worried about being attacked in the future?
There are attacks. They're obviously concerned about what could happen in the future. So far, I think it's fair to say the global shipping industry is quite lucky. I mean, touch wood, we have not seen a major incident where a tanker has been seriously damaged, has been loss of life, or a tanker has been sunk. But today, for example, we had a Norwegian-owned vessel that was attacked. As far as we can tell, it had no connection to Israel. So the idea that the Houthis are just targeting shipping that's destined for Israel or has some kind of Israeli connection, like it's owned, for example, by an Israeli company, that doesn't seem necessarily to hold in this case. It seems to be increasingly indiscriminate.
Kayleigh, these skirmishes haven't been isolated to shipping companies. The US military has also faced some risk around this story as well. What's the official response from authorities this morning, Kayleigh?
Well, this is something they're actively looking at, John. The Defense Secretary, Lloyd Austin, is actually in Israel now, along with the chair of the Joint Chiefs, C.Q. Brown, in part trying to advise Israel on how to lighten up in Gaza in terms of their efforts there. But the other effort really is on preventing this from becoming a wider regional conflict, because you are exactly right, John. It is not just commercial vessels that are potentially in the line of fire here. It is U.S. military aircraft as well. There are 19 U.S. warships in this region, 7 of them in the Eastern Mediterranean, and another 12 across the Red Sea, Arabian Sea, and Persian Gulf. And they have had to actively engage just in recent days in shooting down drones, for example. So this is something the U.S. military is very carefully watching. The issue is, John, according to our reporting, the U.S. really can't go this alone. They are trying to make this a multinational effort, and the Arab allies, the Saudis and the Emiratis specifically, we understand, want to approach the Houthi rebel issue differently, and that is really a hiccup here in terms of getting a multi-country effort together to combat these threats. In the meantime, according to Bloomberg's reporting citing U.S. officials, the U.S. is trying to communicate directly with the Houthis via intermediaries like Oman and others, telling them to stop these attacks. John.
Simon, there is reaction in the commodity market. Let's discuss it if we can. Brent crude is up by 3.5%, close to 80 at 79. WTI is back in the 70s, close to 74, also higher by something like 3.5%. Simon, how are you and the team thinking about how this spills over, what the consequences are to the broader commodity market?
Well, one thing we're looking at as well is natural gas prices. Natural gas prices in Europe this morning jumped up even further than the increase we saw in crude oil. There's real concern there. This is a crucial energy route, as I said, and it's not just for crude oil, it's for LNG. LNG imports into Europe, and also shipments and tankers traversing the other way, heading to Asia as well. So there's real disruption there. We're talking about something like, I think as Kevin Brooks said earlier, 9% of global LNG supplies go through that route. You can still send tankers between Europe and Asia and from north, around the world, but they have to go around Africa. Of course, it's a much longer voyage, adds significantly to costs. It's very disruptive. So this is very inflationary all around.
Really important developing story we'll stay on top of. Simon, thank you. Simon alongside Kelly there on the latest from BP a little bit earlier this morning. Let's turn back to the equity market. About 20 minutes into the session, equities positive here by 0.3% on the S&P. On the Nasdaq up by something like 0.15 on the Nasdaq 100. Let's lift the lid on the index and get you some sector price action. Here's Simone Foxman.
Hey, John, yeah, this continuation of those 7 positive weeks for the S&P 500 that we have seen. And for a long time, it looked like this prospect of this Fed pivot had been lifting all boats except energy. That is obviously not the case today, with energy names up over 2%. Major shipping lines, including BP, Maersk, MSC, all suspending transit through the Red Sea, as you were just talking about, on these potential Houthi attacks that they have seen over the last couple of weeks, and lack of knowledge about how to exactly deal with this. We are seeing some names in the energy sector: Baker Hughes, Halliburton, Marathon Oil, really leading the gains today. All of those names up 3%, and virtually every member of this energy index higher today. But overall, you still kind of step back here and you look at an energy sector that has failed to keep pace with the broader market. On the month before today, it was the only sector down month to date. That is no longer the case for the quarter. It is the only sector down this quarter, over 6%. That is setting us up for the biggest quarterly decline since the third quarter of 2020. And it is the second biggest sector laggard this year, second only to utilities.
It just hasn't participated. Simone, thank you. Thank you for bringing that up, because I think it's so important. Since the end of October, looking at energy names on the S&P 500, they're just about flat. On the S&P, we've seen double-digit percentage point gains on the S&P 500 over that period. If you look elsewhere, look at the financials, the banks on the S&P 500 up by more than 20% over the same period. Just massive underperformance on energy. Outperformance today, top of the pile. That group of stocks on the S&P 500 advancing by something like 2.2%. Coming up, we'll get you to the trading diary, the guidebook, the playbook through the rest of this week to try and get you through the week into the weekend and onto Christmas and the holidays. From New York City, that's next. This is Bloomberg.
2023 looks like it's going to end up being a very substantial reduction in inflation without a big increase in the unemployment rate. That's the golden path that I talked about. But we're still above the target. We got to get inflation down to target before, until we're convinced that we're on path to that. It's an overstatement to be counting the chickens.
That's the pushback from the Federal Reserve. This market ain't listening. This market's still rallying. 25 minutes into the session on the S&P 500, up by 0.25%. Can you put the toothpaste back into the tube? Neil Dutta of Renaissance Macro saying you can't. The comments from Chairman Powell on Wednesday, the headline, everything else, just a footnote that no one's reading. That's the price action this morning. Let's get to the trading diary. A week ahead looks like this. Tuesday, the BOJ's rate decision just around the corner. Plus, FedEx reports earnings after the closing bell. On to Thursday, we'll get US GDP and another round of jobless claims, followed by quarterly results from Nike and Carnival Cruise Lines. From New York City, that does it for me, at least for this morning. I'll see you tomorrow. Thank you very much for choosing Bloomberg TV. This was the countdown to the Open. Good luck for the rest of the trading day. This is Bloomberg.